Professional real estate investors rarely buy a multi-million-dollar property with their own cash. They use a specific sequence of loans to scale their portfolio faster than their personal bank accounts would allow, dividing the total cost into highly specific layers of debt and equity. The blueprint for this maneuver is called the capital stack. Think of it as the financial DNA of a property, a map showing every single dollar required to purchase the asset, organized neatly into a hierarchy of priority. This diagram shows exactly how that hierarchy works. There are two golden rules governing this stack. The first is the priority of payment. When a property generates rent, that cash flow always pays the bottom block first. Only when that base layer is entirely satisfied does the money flow upward to the next level. The second rule is risk versus return. Because the bottom gets paid first, it is the safest place to put your money, but you accept the lowest interest rate. At the peak of the stack, you take the first hit if the property loses value, but you also keep everything that is left over after the lenders take their cut. The very bottom of this structure is senior debt. This is your traditional mortgage, usually provided by a major bank or insurance company, and it makes up the massive foundation of the deal, typically covering 50 to 70% of the total purchase price. Senior lenders charge the lowest interest rates in the entire stack, but they demand a serious catch. They hold a first priority lien on the actual physical building. If the borrower stops paying, the bank forecloses and simply takes the real estate. Because the senior lender holds the ultimate safety net of physical collateral, they tap out at that 70% mark. That forces the investor to go out and find alternative, much riskier money to cover the remaining costs of the acquisition. If your senior loan covers 65% of a building's price and you only want to invest 10% of your own cash, you are left staring at a 25% funding gap in the middle of your stack. To bridge that exact gap, investors use mezzanine debt. This middle layer acts as a financial shock absorber between the bank's mortgage and the owner's cash. But mezzanine lenders take on a lot of exposure, so their terms are brutal. They don't have a claim to the physical building. Instead, they hold a lien on the LLC ownership entity. If the deal goes south, a mezzanine lender can legally seize control of the entire holding company in a matter of days. Sitting precariously at the very top of the stack is the equity. This is broken down into preferred and common equity, and it represents the actual out-of-pocket ownership cash used to buy the deal. Equity takes the first loss. If the property's value begins to drop, the equity investors lose their capital entirely before the mezzanine or senior lenders lose a single dime. By accepting the highest probability of a total loss, equity secures the right to the upside. Lenders are legally capped at their fixed interest rates. If the property skyrockets in value, the equity investors keep every single dollar of the remaining profit, securing unlimited upside for their initial risk. Structuring the money is entirely theoretical if the physical property can't generate enough rent to survive the debt payments required to keep the lights on. To prove a building can survive, lenders rely on a formula known as the debt service coverage ratio, or DSCR. You calculate this by taking the property's net operating income, its total revenue minus operational expenses, and dividing it by the annual debt service, which is the total mortgage payment due over a year. A DSCR of exactly 1.0x means the property makes right down to the penny what it needs to pay the mortgage. If a single tenant moves out or a pipe bursts, you are instantly losing money out of pocket. There is zero room for error. That is exactly why commercial lenders enforce strict minimums, usually requiring a DSCR of 1.20x to 1.35x before they will approve a loan. This creates a mandatory 20 to 35% cash cushion. That buffer acts as the property's life insurance, absorbing the financial blow of unexpected vacancies or rising taxes and protecting the owner from immediate foreclosure. But that life-saving DSCR cushion is highly vulnerable to the structure of your interest rate. Investors have to choose between fixed and floating rates, and that single decision dictates the stability of the entire stack. Fixed rates lock in your exact payment for a decade, giving you total predictability. Floating rates offer early exit flexibility for renovation projects, but the interest rate fluctuates constantly based on a broader market index. Watch what happens on this graph when a floating rate is left unchecked. If the broader market experiences a sudden rate spike, your monthly mortgage payment increases, violently shrinking your DSCR cushion until the property goes negative. To prevent this scenario, lenders force investors to buy an interest rate cap. This is a mandatory hedging strategy, essentially an insurance policy you buy up front that acts as a hard ceiling against rising rates. Without a hedge, a single macroeconomic shift can wipe out your entire capital stack. By capping the interest rate, the downside is strictly mathematically limited, ensuring the property's cash flow survives the turbulence. Every layer added to the stack is a trade-off. Increasing your leverage can double or triple your equity returns when the market is stable, but it simultaneously thins your DSCR cushion, moving the property closer to the edge of foreclosure. Highly successful developers do not look for the cheapest money available. They look for the smartest, most resilient capital structure tailored to their specific business plan and timeline. Ultimately, the stack is a tool for engineering a deal's resilience. Success comes down to matching the right layers of debt to the specific performance of the building, ensuring the structure holds together long enough for the equity to grow.